Regionals and big banks rising today ahead of tomorrow's Fed decision, continuing the strength they've seen all month. Both groups up double digits in July, and financials are the second best performing S&P sector this month. But one top money manager sees short-term challenges ahead. Macrae Sykes is a portfolio manager at Gabelli Funds, runs a Gabelli Financial Opportunities ETF. Mac, great to have you with us.
Thank you.
So they pull forward gains?
Well, I mean, we've had a huge run-up into this print tomorrow, and I think that we're all excited about future rate cuts. I think tomorrow we'll just get kind of a movement towards an expectation in September for 25 basis points, maybe 50 basis points. Depends on the economic data on Friday. And if you think about the earnings that just came from 2Q, pretty good, bottoming of NIIs, better commentary from the bank. So I think it's a good setup for earnings 24 going into 25, better Fed. Lower deposit costs and maybe a normalized curve. Mm-hmm. So that's a pretty good setup for the big banks.
But that's not going to be enough to help the smaller banks where you see potentially still landmines out there in terms of real estate.
Right. I think, they've all been lifted on this. And, I think that's an easing of the Fed policy. And then we've also seen the real estate group kind of rally as well. But you have to go house to house and the credit to credit. And, we still see some hot spots related to New York Community Bank, for one, Flushing Financial. There are still some more challenged portfolios.
KRE is at a great run, as you know. But right. I look at, we talked about Intel laying off people. If the unemployment rate starts to move, the economy slowing down. Those all should be headwinds for a sector that's done extraordinarily well over the last month and a half, 2 months. So is this one of these things where these banks have gotten way too ahead of themselves?
Well, it's possible. I mean, I think the big banks are up 16, 17%. And we've seen fundamental improvement there. And then the kicker coming in probably fourth quarter is the capital markets, IPO markets, and that'll be a big help for them. And they're still having headwinds in terms of NII. Just look at JP Morgan, et cetera. But I think, we're going to get a normalization unemployment as long as we don't kind of steepen and go off the curve there. Well, credit should normalize. Even when you think about the trajectory, we're still at pretty low levels of unemployment historically. And when I look around New York, it's pretty active as well. So I think in the commentary, too, whether it's American Express, Bank of America, it's still pretty good. So we'll have to see how that data trajects. But for the most part, I think they're in good shape fundamentally.
Do you think the run-up in the regional banks is, how much of that do you think is due to acquisition hopes?
So there's a number of things about that. I think obviously it's a little easier policy in terms of the balance sheet's more manageable, and then the outlook in terms of deposit costs. So if we know that's being capped by the Feds at some point, then that's helpful. But also you have the elections perception around Trump, Kamala, et cetera, in terms of the outlook for regulations. But I think everybody knows that there needs to be consolidation in the smaller banks, and I think that will be appreciated regardless of who gets elected in the fall. But you also need to have more fundamental, better improvement kind of in the underlying fundamentals for the small banks as well in order to get consolidation. Because a couple of months ago, we were still looking at kind of capital holes and worries and also integration and approval. So I think part of that's moving in the right direction. And for next year, I think that will be helpful. But we have to see that underlying. And a normalized yield curve helps everybody.
Hey, Mac, you just mentioned the headwinds to net interest income. And like you said, you mentioned JP Morgan. Wells Fargo had some issues there. When you look at a Bank of America and you look at the results that they had and you look at why it's underperformed over a multi-year period, we get it. We know what happened in 2022 and that sort of thing. But when you think about like Warren Buffett selling here and he owns more than, he's obviously a number one shareholder. When you think about that, is that going to be a big overhang for this company, for this stock in particular?
Well, one of the world's most renowned investors selling a big position. I think it's obvious pause on it. They've sold 70 million shares. They still have 960 million shares. So that's $40 billion. When you talk about a $14 cost, that's $26 billion of embedded gains. Now, there's a couple of reasons they may be selling. As the number two position besides Apple, it's a big concentration. It's one of Warren's particular one. So maybe there's a little legacy planning in terms of turning it over to his investment managers and their priorities in terms of the portfolio. Number two, they've talked about the Apple position and wanting to sell potentially ahead of corporate tax rates, maybe moving higher in the future, given the deficits, et cetera. So that would be, a move to lower the tax burden by selling this year versus in the future, just given the embedded gains in that. And then, it had a terrific run here. And they may be just wanting to trim and take those profits in a bigger position.